The one big beautiful bill is now a law. President Donald Trump officially signed it as a law on July 4, 2025, paving the way for its implementation. It's a 900-page bill which promises significant changes. In this video, I will break down the key changes in this act that will impact your personal income tax and personal finances. So some of these changes are applicable from current tax year, which is 2025, and some of them are applicable from next tax year 2026. So this is Arvind Varganti and you are watching the Personal Finance Coach. So let's start with the remittance tax. The Act imposes a 1% remittance tax on all international money transfers, but only if it is funded by either cash or money orders or cashier checks or similar instruments, either through banking or non-banking channels. And this tax is applicable to all the individuals, including US citizens. And this is applicable from January 1st, 2026. And remember, this remittance tax does not apply to US funded transactions. So if you transfer funds overseas from your regular bank account, or if you are transferring funds using services like Wise, Remitly, Xc, Zoom, etc., then this remittance tax is not applicable for those transactions. It is only applicable if it is funded by cash or money orders or cashier checks. Standard deductions. So with regard to standard deductions, as far as the single filers are concerned, the standard deduction is increased to $15,750. And as far as the people who are filing with the status of married filing jointly, the standard deduction increased to $31,500. And for the people with the status of head of household, the standard deduction is increased to $23,625. And this change is applicable from current 2025 tax year. So when you file your taxes for 2025 after December 31st, 2025, then you can enjoy this upgraded standard deductions. And this amount is again will be adjusted for inflation for subsequent tax years. So in subsequent tax years, this can increase depending on how the inflation goes. The next one is about senior deductions. So the one big beautiful bill includes a temporary tax deduction for older Americans, specifically those age 65 or older. So all the seniors with the age 65 or above filing with the single status can claim additional bonus deduction of $6,000. And if they are filing with the married joint status, then they can claim a bonus deduction of $12,000. Again, this change is applicable from current 2025 tax year. This benefit phase out for the single filers with income 75K or above, and for people with filing with married filing jointly status, this additional bonus deduction phase out after 150K income. And this tax break is set to expire in 2028 unless Congress extends that. And the White House claims that nearly 90% of the Social Security beneficiaries will pay no federal tax on their benefit due to this bill. Child tax credit. The child tax credit is increased from $2,000 to $2,200 per child. And again, this change is applicable from current 2025 tax year. And of course, there are certain rules applicable in order to claim child tax credit. The child must have an SSN and the child should be less than 17 years old. At least one parent must have a SSN. Earlier, the rule was that both the parents should have an SSN, but now only one parent can have an SSN. And this benefit phase out for single filers with income 200K or above, and for the people filing with the status of married filing jointly, this benefit will phase out if they have income above 400K. And the child tax credit is again tied to inflation. So as the inflation rises, the child tax credit will increase in future. And this big beautiful bill introduced certain changes as far as the workers who earn tips and overtime. So workers in traditionally tipped industries, probably maybe hotels or your hospitality industry, can deduct up to $25,000 in qualified tip income annually from their income while calculating federal tax. This deduction is available even to those who doesn't itemize while filing their income tax return. Overtime, again, a deduction is available for a qualified overtime pay, and again, it's capped at $12,500 for single filers and $25,000 for married filing jointly. This change is again applicable from current 2025 tax year. And again, overtime deduction also applies to workers who don't itemize deductions. Overtime, of course, must be paid in compliance with the FLSA, which is your Fair Labor Standards Act, meaning the overtime pay should be 1.5 times the regular hourly rate. This benefit again phase out for single filers if with the adjusted gross income of 150K or above, and for married filing jointly with income above 300K. These deductions are available again until tax year 2028 unless Congress extends them beyond 2028 tax year. Car loan interest deduction, again, this is a new deduction which was introduced in this bill. So you can claim deduction up to $10,000 in interest per year. And this change is again applicable from current 2025 tax year. Of course, there are certain rules which are applicable. So car should have been purchased after the bill is passed. So that is, the car should have been purchased after July 4, 2025. Vehicle should have been assembled in US, and it applies to both personal and commuter use vehicles. And the deduction is again available only until 2028 tax year unless Congress extends it. And of course, no itemization is required in order to claim this car loan deduction. This deduction is again not available for individuals earning more than $100,000 or couples making more than $200,000. Again, the next item is about charitable deductions. This act now permits non-itemizers, that is the taxpayers who do not itemize in their income tax return, to take charitable deduction benefit up to $2,000 for joint filers and up to $1,000 for all other filers. Again, this change is applicable from it's not current, it's applicable from 2026 tax year. SALT deductions. So SALT stands for state and local taxes. The SALT deduction is a federal tax benefit that allows taxpayers who itemize their deductions to deduct certain state and local taxes from their taxable income. This deduction is intended to prevent double taxation by allowing taxpayers to reduce their federal tax liability by subtracting the income that has already been paid as state and local taxes. So the SALT deduction is increased from $10,000 to $40,000 as part of this particular act. And this SALT deduction includes your state and local income taxes or state and local general sales taxes, state and local real property taxes, that is the property tax paid on individually owned your real estate properties. Taxpayers may find it advantageous to itemize deductions rather than taking the standard deduction under this new $40,000 cap. Again, a couple of points to note. This SALT deduction is applicable only to those whose your AGI or adjusted gross income is less than 500K. This will be reverted back to $10,000 in 2030 unless again Congress extends it. This deduction increases by 1% every year through 2029 tax year. The next one is about SNAP benefits. SNAP stands for Supplemental Nutrition Assistance Program. SNAP provides food benefits to low-income families to supplement their grocery budget so that they can afford the nutritious food essential for the health and well-being. So some of the changes as far as the SNAP program is concerned are SNAP benefit levels are recalculated every 3 years instead of every 5 years. Now the SNAP calculation now accounts for inflation-adjusted food cost and updated nutritional guidance. The age range for mandatory work requirements has increased from 18 to 49 to 18 to 54. Thank you. Thanks for watching my video. For interesting videos on personal finance, please do subscribe to my channel. And if you feel that you learned something new, please like and share. Thank you.